You budget meticulously on a spreadsheet. You earn an average salary, contribute a few percent to your retirement fund, and you never carry credit card debt. Every month, whatever is left over goes straight into a savings account. By all conventional measures, you are a responsible adult making smart choices. But this graph shows what is actually happening. While your bank pays you a fraction of a percent in interest on that flat bottom line, average inflation climbs steadily above it. Every year you save like this, you are quietly losing purchasing power. You are managing the controlled erosion of your own money and calling it discipline. Which brings us to a strange contradiction. If avoiding debt is the ultimate financial virtue, why do the apps on your phone constantly prompt you to buy now and pay later? Why is instant frictionless credit pushed everywhere you look? Debt functions as the foundational engine of the modern economy. The system requires a constant influx of tomorrow's income just to maintain today's growth. It pulls future earnings into the present, creating the liquidity that keeps global markets from grinding to a halt. While you meticulously follow the rules of the visible system, saving pennies and avoiding liabilities, the institutions that actually control the world are playing a completely different game, one built entirely on massive compounding leverage. This timeline illustrates macroeconomic debt. Without borrowing, economic growth slows. Debt pulls future money into the present, accelerating the entire growth curve. Zooming out globally, total debt exceeds $300 trillion, dwarfing the planet's economic output. Governments are structurally addicted to borrowing, running enormous deficits. When massive shocks hit the system, crises like the pandemic or sudden global conflicts, governments have to spend billions overnight to keep society functioning. They rarely fund this by raising taxes, because sudden tax hikes are political suicide. Instead, they borrow. They issue bonds promising investors a return with interest. But to pay that interest when it comes due, they usually don't use tax revenue. They simply issue a new round of bonds to pay for the old ones. It creates a continuous loop. You borrow to pay for past borrowing, which requires even more borrowing tomorrow. It works smoothly to sustain economic growth right up until the sheer compounding volume of that debt threatens the stability of the system itself. There is supposed to be a natural limit to this cycle. The global investors who buy these government bonds, often called bond vigilantes, can demand fiscal discipline. If they think a government is spending recklessly, they stop buying, forcing borrowing costs to spike. We saw this happen in 2022. The UK government under Liz Truss proposed aggressive, unfunded tax cuts. The bond market revolted, borrowing costs skyrocketed, and the resulting panic rapidly tanked the market, forcing an immediate reversal and her resignation. But modern governments have an override switch. When the open market refuses to buy the debt, a nation's central bank can step in and buy its own government's bonds. This artificially suppresses interest rates and prevents a financial death spiral. Japan has demonstrated exactly how far this can go. The Bank of Japan has systematically purchased enough government bonds to override any market pressure, allowing the country to absorb massive debt levels, well over double its gross domestic product, without triggering a crisis. This diagram shows inflation as a mechanical stabilizer for high debt loads. As prices and wages rise over time, the real weight of that debt begins to evaporate in nominal terms. The burden of repayment gets steadily lighter because the currency used is worth less. This erosion is highly intentional. If governments had to pay back their massive deficits entirely through tax hikes or brutal austerity cuts, the resulting economic pain would cause immediate political collapse. Inflation offers a quieter alternative. The rising prices you see at the grocery store, the same inflation that steadily eats away at your responsible savings account, is the system digesting its own leverage. The global economy balances its books using your lost purchasing power. This mechanism is highly durable. The institutions at the center of the financial world, including the United States government, will continue to issue trillions in debt. They will continue to rely on a combination of endless borrowing and baseline inflation to keep the gears turning, which creates a stark division. The working class holds wages, and the purchasing power of a fixed wage erodes week by week. The wealthy hold assets, equity, real estate, and leveraged investments that actively inflate and compound inside this exact environment. The individuals operating at the top of this system don't get there by working longer hours. They build wealth because they understand capital structures. They use private credit and calculated exposure to capture compounding returns, while the rest of the world trades time for dollars. You are left with two distinct paths. You can stay in the passenger seat, carefully managing a spreadsheet while your baseline financial position slowly degrades, or you can start learning the actual language of capital and become an operator. Financial ignorance is a structural disadvantage that ensures your labor pays for the system's survival. The rules of leverage and yield are constant and documented. They simply require an operator's perspective to navigate. The system was never designed to be fair. It was designed to move, and the only way out is to learn the mechanics of the game.